Hi, I'm Jared Nelson from the Investing Channel, and welcome to The Juice. This week, the U.S. Fed laid a clear path to higher interest rates as a way to combat inflation. Turkey, on the other hand, cut interest rates, sending the lira plunging to new lows as hyperinflation becomes a reality for the country. Each country is handling inflation differently, and it's creating some very interesting outcomes. Let's start with Turkey, Europe's gateway to the Middle East. President Erdogan's decision to slash interest rates by 500 basis points since September spurred 21% inflation. Forecasts already call for 30% next year. It got so bad the country's central bank directly intervened in the market to prop up the battered Turkish lira. But unlike Turkey, most emerging markets raised rates this year to combat inflation. Even Russia is in the mix, with rates at a whopping 8.5%. But despite a slowdown, China kept interest rates high as it seeks to transform its economy, shed poorly performing companies, and rein in real estate companies like Evergrande. Moving to Europe and front-running the Fed, the UK's central bank announced a small rate hike to compare inflation, which was unexpected. Unlike the Fed, the Bank of England doesn't carry the dual mandate of inflation and unemployment, and it solely focuses on currency stability. Officials at the European Central Bank followed the Fed in cutting its bond purchases. However, it's one of the few developed economies that refuses to substantially reduce monetary policy support in 2022, or at least talk about it. Known for the lost decade of economic growth in the 90s, Japan appears to be immune to inflationary pressures. Citing this as evidence, the country's central bank refused to speak of tightening, defending their extremely dovish stance. So, when everyone raises rates at the same time, it doesn't really change the relative price of one currency to another. Instead, it dampens demand within the home country. That's a key reason why the US and emerging markets need to raise rates. But the EU is in a pickle since inflation differs for each of its members. The bottom line is this. History has shown that raising rates too quickly can push an economy into a deep recession, if not an outright depression. That appears very unlikely in the US as well as emerging markets. We are concerned with the dovish approach by the EU, as members like Germany have a historical animus towards inflation. From a sector perspective, we still favor regional banks and construction. We also like industrials that favor emerging markets, such as Caterpillar. That's all we have time for today on The Juice. Click, follow, and subscribe to The Juice email for your daily dose of market minerals.